Can dividends increase a company's value, or do they not matter at all? Finance experts have debated this for decades. In this video, we'll compare 5 famous dividend theories and see how each one views dividends. What if I gave you 100 rupees and took 100 rupees from your pocket at the same time? That's exactly how dividends work according to theory. In 1961, economists Merton Miller and Franco Modigliani introduced a shocking idea, dividend irrelevance theory, also known as approach or theory. They argued that dividends do not affect a company's share price. According to them, a company's value comes from profits, growth, and earnings, not from dividends. Let's understand the theory with an example. Imagine a stock is worth $10. The company pays a $1 dividend. What happens next? The stock price falls to $9. So you received $1 in cash, but lost $1 in share value. Net gain? 0. Believed that if a company keeps its profits instead of paying dividends, it can reinvest that money and grow faster. And if investors want cash, they can simply sell a small part of their shares. That's why concluded, dividend policy does not determine a company's value, growth and earnings do. According to it's not the dividend that creates wealth. It's what the company does with its profits. What if I told you behind every rising share price, there's a hidden battle between dividends and business growth? In 1962, Myron J. Gordon introduced the Gordon model, a theory based on one simple idea. A company's dividend decisions can affect its share price. This model says investors care about dividends, company growth, and future profits. Gordon assumed the company runs forever. The business uses only shareholders' money. Taxes do not exist. The company keeps the same saving policy, and saved profits are used for future growth. According to Gordon, growth is equal to retention, rate multiplied by rate of returns on investment, which means that company growth depends on how much profit is saved and how well the company uses that money. Here you can see the Gordon's formula, an important rule used by him. This rule implies that investors' expected return should be higher than the company's growth rate. In the end, every company must choose, give profits to shareholders, or use them to build something bigger. What if I told you investors trust cash more than future promises? According to Benjamin Graham and David Dodd, dividend policy can directly affect a company's share price. Their traditional model says higher dividends often increase market value. Why? Because investors feel safer receiving money today instead of waiting for uncertain future profits. This idea is called bird-in-hand theory. As you can see, according to the model, dividends play a major role in determining share prices. But there's a catch. Some companies pay low dividends and still grow massively because retained profits increase future earnings, and some investors actually prefer capital gains over dividends. So the big debate in finance is, should companies pay profits or reinvest them for future growth? What if Imagine a company earns huge profits every year. Now the big question is, should the company distribute profits to shareholders or reinvest the money back into the business? According to James E. Walter, the answer depends on just 2 things: return on investment and cost of capital. If the company can generate returns higher than investor expectations, then reinvesting profits is smarter than paying dividends. But if the company earns low returns, shareholders are better off taking dividends and investing elsewhere. In simple words, high returns, reinvest profits. Low returns, pay dividends, and that single decision can completely change a company's market value. Imagine, why do some companies become billion-dollar giants while others with the same amount of money fail completely? Financial management isn't just about raising funds. According to the Solomon approach, finance is an integral part of overall business management. Economist Ezra Solomon believed that the main purpose of financial policy is the wise use of capital funds. In simple words, every investment should be judged by comparing the return it generates and the cost of the money invested. Solomon also introduced a powerful objective, wealth maximization, meaning the ultimate goal of a company should be to maximize shareholders' wealth through a higher market price of shares. His approach considers time value of money. Money received earlier is preferred over money received later. Risk adjustment. Higher risk means returns must be evaluated more carefully. According to Solomon, every finance manager must make 3 key decisions: investment decisions, financing decisions, dividend decisions. So the conclusion is, great companies don't just raise money, they use it wisely.